So I'm Mac McComas. I'm the Senior Program Manager at Johns Hopkins 21st Century Cities Initiative, and I'm the co-author, along with Anthony Barr, of a new report looking at minority-owned banks in the US. And that's going to be the focus of our conversation today, looking at the state of the minority banking sector and financial inclusion. So before I jump into the program itself, I just wanted to give a brief overview of the agenda for today. So myself and Anthony are going to start off for the first about 20 minutes or so, giving some highlights from our report. Then we're going to turn it over to Amin Azad, who's going to provide about 5 to 10 minutes of comments and feedback on the report. And then we're going to go open it up to a panel discussion from some great panelists that we have for you today, who we will introduce closer to that portion. And then we're going to have audience Q&A. But as I mentioned, feel free to throw your questions in the chat or use the Q&A feature kind of as you're able to. Great. So with that, I'm going to jump into some highlights on my section of the report here. So we published this report, Minority Depository Institutions, State of Knowledge, Sector Summary, Lending Activity and Impact from 2010 to 2022 back in May. And I really became interested in this work nationally after exploring access to credit for small businesses in the Baltimore area, looking at research on the entrenched racial wealth gap, research on the lack of upward social and economic mobility in many American communities. And that led me to have discussions with folks such as Anthony and Amin and Kristen to think about the role that the financial sector, and in particular, minority-owned banks and CDFIs and community banks could help alleviate some of these issues. So this report specifically focuses on minority-owned banks, or MDIs, minority depository institutions. I'm not going to, read the description of it here, but essentially, we wanted to look at MDIs because while there was a growing body of research on how MDIs provide financial products to minority borrowers and are located in communities with higher poverty rates and non-white populations, the research on them is relatively sparse, especially recent research. So our motivating questions going into this were, again, looking at kind of what the current state of knowledge is on MDIs, so doing kind of a literature review, looking at how the sector has changed since 2010, and then really focusing on the communities served, the types of folks served, lending activity, and exploring possible impact of MDIs. So took a kind of a broad look at the literature, and there was a large consensus that MDIs serve communities that have higher shares of minority and low and moderate income populations, and there were this is probably the most consensus that there was in the literature. More recently, there have been some papers on how MDIs responded to the COVID-19 pandemic and how they were, in particular, able to disperse more PPP loans than their peer banks and institutions, and more of that credit went to minority borrowers. Looking back at the Great Recession, one paper found that if the banking industry had performed similarly to how MDIs had, almost 2 million minority jobs would have been maintained, and an additional 50 billion per year would have been available for small businesses. However, there's a long history in academic literature going back to the 70s, but even looking more recently, of papers finding that MDIs are less efficient than their peers. However, there have been 3 recent papers that compare MDIs to non-MDIs that serve similar communities using statistical techniques, and find that actually they are not less efficient than their peers if you look at similar communities served. So next, going into some of the findings from our report, kind of looking at the state of the minority-owned banking sector. Branch closures were highly concentrated among a small number of MDIs. So over this period in the banking industry generally, concentration was a big issue. But among MDIs, it was highly concentrated among a small number. So just 9 MDIs accounted for over 500 branch closures. 6 of those were MDIs that closed down entirely. So as an example, the International Bank of Commerce, Hispanic-owned MDI headquartered in Laredo, Texas, closed 181 branches from 2010 to 2022. But it's not all a story of consolidation. Over the same time, 54 MDIs increased the number of branches, including Cathay Bank, headquartered in LA, which opened 19 branches. Looking at asset growth, which is that chart on the right, a significant amount of growth occurred between 2019 and 2021 when assets grew by 24% during the pandemic. And this holds true for the industry as a whole, the banking industry as a whole. And the recent growth in assets was driven in part by the Treasury Department's Emergency Capital Investment Program, which invested over $3 billion in the sector. Looking at closures by different types of MDIs, the number of Hispanic and Black-owned MDIs declined by about the same number over the period, 12 and 13 respectively. Asian-owned MDIs accounted for about half of the loss of 52 MDIs over the period. However, in terms of percentage reduction, Black MDIs suffered the heaviest losses, losing nearly 40% of those institutions. I'll say, though, that it's important to note, as we found in our literature review, that most of this consolidation was voluntary to achieve economies of scale, and the majority of assets were retained within the MDI industry. So next we looked at, as I mentioned, the geography served. So this is a map of MDI branches by state. And as you can see, there's heavy concentration here. MDIs had a presence in 32 states and territories, 92 cities, and 732 zip codes. They're also heavily concentrated in urban areas. So 87% of MDI branches are located in urbanized areas compared to just 68% of non-MDI branches. Yet, while they're concentrated in cities, there are several large cities such as St. Louis, Pittsburgh, Cincinnati, Cleveland that don't have a single MDI branch. Then looking at kind of geographic competition and concentration, we found that MDIs were the only bank branch that existed in 174 zip codes, providing bank services to over 3.5 million people that might not otherwise have access to a bank branch. In 25% of MDI service areas, they were the only bank branch present in that zip code. And so this is the case for the bank in the bottom picture there, which is the Bank of Cherokee County, which is located in Oklahoma. Many of the zip codes that we looked at in Oklahoma, an MDI was the only bank branch present. Then we looked at, okay, so among these communities that were being served by MDIs, what was the kind of demographic breakdown? So majority of MDI branches, or 62%, are located in zip codes with poverty rates higher than the national average. This can be compared to just 38% for non-MDI branches. The median zip code where an MDI branch is located had a poverty rate of 17% in 2021, which was almost 5 percentage points higher than the national average, and 7 percentage points higher than zip codes served by non-MDI branches. The median zip code where an MDI branch is located is 51% white, and the median zip code where a non-MDI branch is located is 79% white. And so again, if you look at this chart, which shows kind of the owner-operator status of MDI. So A MDI is Asian MDI, B MDI is Black-owned MDIs, and so on. That what I'm trying to show in this table is that the ownership of the MDI is really reflected in the communities that they choose to serve. Next, we looked at some measures of economic and social cohesion and mobility developed by Raj Chetty's team at Opportunity Insights at Harvard. And this table shows some of those measures as broken up by MDIs, non-MDIs, and non-MDI community banks. And to ensure that we were comparing similar communities where MDIs and non-MDIs and community banks were located, we restricted the data set to somewhat comparable communities that had a non-white population higher than 50% and a poverty rate greater than 15%. And what we found was that economic connectedness was significantly higher in MDI zip codes than in non-MDIs and non-MDI community bank zip codes. And neighborhood economic connectedness was also higher in MDIs, as was to a lesser extent the volunteering rate. We also looked at another measure of economic mobility, the share of children in low-income families who grew up to have incomes in the top 20th percentile based on household income. And we found that counties where MDIs were located had a higher share of economically mobile people, so 11%, compared to non-MDI branches, which had 8%, and non-MDI community banks, which was 7%. Now, again, these higher levels of cohesion and mobility could be caused by MDIs located in these communities, or MDIs could simply be located in areas with these higher levels. We'd really need more in-depth research on this to kind of determine these causes. And then finally, we looked at some climate risk data from the First Street Foundation. So what this table shows is the average share of properties at risk by the type of bank branch that was present in a zip code. And wanted to highlight just a couple things in these red circles. And that is the large differences in exposure to heat and wind, comparing MDIs and non-MDIs. So if you look at MDIs with a high risk of heat, the zip codes that they're at have an average of 46% of properties with a high risk of heat compared to just 27% for non-MDI zip codes. Again, looking at wind, it's almost twice as high, the share of properties with high risk. And then on the right side of the chart, kind of looking down all risk categories for Hispanic-owned MDIs, but especially for heat and wind, the communities where Hispanic-owned MDIs are present have a much higher share of properties at risk of heat and wind exposure. So just before I hand it over to Anthony Barr for his section, wanted to have some closing thoughts. So this research really looked at kind of a high level of the state of the sector and areas and communities served. So I think we need to do and have more research on the causes and consequences of the MDI sector expansion and consolidation. Going back to some of those social and economic mobility measures, need to think about kind of the welfare and the social and economic mobility implications of access to credit for minorities and underserved communities. So kind of simply put, does increasing lending in minority communities improve economic mobility and social cohesion? Then a lot of our data looked at kind of metro area, county, and zip code level data. It would be great if we could do more research on kind of the census tract or the neighborhood level. And then one of the big limitations is that we know that MDRs have a presence in some of these neighborhoods, but we don't know the race of the borrower in most cases. Although, as you'll see shortly, Anthony does have some data on that, but he'll share that with you. So I'm going to hand it over to Anthony Barr to present on some of the data from his section of the report.
Well, thanks so much, Mac, for getting us started. While I pull up my screen, just want to thank all of you for joining us today. And also want to thank John Hopkins University for hosting this webinar. Let's see. Mac, can you enable me to share the screen? It looks, oh yeah, there we go, perfect. So as Mac said, I'm with National Bankers Association Foundation. We have been serving minority banks for almost 100 years, helping to mitigate the racial wealth gap and support economic mobility for people in places that are marginalized or cut off from mainstream financial institutions. And so as part of the report that I worked on with Mac, we did the sector overview, and then we also looked at a lending sample from 10 MDIs based on their 2021 loan originations. And so as part of this, we tried to be kind of representative in, the banks that we chose along kind of racial lines and also along the size of the banks. And so we have MDIs that are 100 million or less in assets, all the way up to an MDI that is well over 1 billion in assets. So collectively, these 10 banks deployed over 57,000 loans in 2021 for a total of 3.4 billion in loan originations. And as Max said, 2021 was an odd year in that we had the Paycheck Protection Program that was set up by SBA in order to help stabilize small businesses and workers at small businesses amidst the economic shock of the pandemic. And happy to say that our 10 banks in the sample deployed over 20,000 Paycheck Protection Program loans. Now, we did have one bank that was kind of an outlier in size, and so we wanted to kind of see what does it look like to filter out that bank and kind of see, with the other 9 banks, and it was still almost 20,000 unique loans and $1.7 billion, even when controlling for that outlier. Our sample banks are headquartered across the United States in terms of the regions, with heavy presence in the South corresponding to the Black banks in particular. But as you can see, lending reached across a variety of places, and some of the lending being heavily located in Texas, New York, California, and Georgia, and South North Carolina kind of represent where MDI branches are heavily located. But again, a pretty stunning reach of like 6,000 unique zip codes, 3,000 distinct cities, covering populations that are home to over 51% of the US current population. And when we look at the lending categories, you can see that consumer lending came in really high from our sample. So this is small dollar loans typically for things like, a car breaks down and you need an emergency loan in order to repair it. This was, again, reflective of one bank having kind of a lot of their portfolio being consumer lending. And so when you exclude that outlier bank, commercial real estate and PPP are the main ones, which kind of correspond with the literature as well. I like to describe commercial real estate as kind of the thing that allows MDIs to keep the lights on. So for a number of institutions, it's about 50% of their loan portfolio. And you think about kind of the size of those kinds of deals, allowing to kind of sustain other portions of the business model where the margins might be tighter. In terms of race and ethnicity, as Max said, we tried to collect that as part of the sample, and it was kind of sporadic. There's a lot of challenges for institutions in being able to collect that data in a way that doesn't run them afoul of regulators. Some of the infrastructure to be able to collect some of that data is not there, and so that's something that we're working with the sector to grow into. But in the meantime, using kind of the zip code population of places where lending went, we can say that 53% of the population in the zip codes in the lending sample are minority, and places that have that 53% or higher minority share account for 77% of the loan dollars in the sample. Now, I'll note that when you exclude PPP lending from the sample, the percentage share jumps up pretty substantially. And that's probably reflective of the fact that a number of MDIs partnered with nationally focused fintechs in order to deploy an even greater number of Paycheck Protection Program loans. And so that's probably kind of reflected in just the nature of that partnership. We do have the zip code median household income here. I'm not going to spend a lot of time on it. In the report, we also segment it out by household income by race. But the thing that I will say is that zip codes can be pretty large. And so especially if you're thinking about variation in a census tract level or in a city at the block group level, I think often that the poverty rates are actually a little bit more indicative of what's going on. And so To that point, we use two different poverty measures as part of thinking about where lending is going. The first is the 100% of the federal poverty line. So that's, the federal poverty line's here and you're underneath it. The second measure is 125% of the poverty line. Oops. And that's basically the poverty lines here, and you're only slightly above it. And so the idea being there that you're probably still facing a lot of economic hardship and financial vulnerability, particularly in periods of downturn or during the last couple of years where we've had high levels of inflation. And so that chart at the top is basically showing that our sample had a greater amount of poverty than the nation as a whole. 76% of our lending went to zip codes that have a greater poverty rate than the national rate. And then that table at the bottom, we filtered zip codes by, are you 51% or higher, Black, Hispanic, Asian, white, and looked at the poverty rates at the 125% level and the household income that way too. And kind of, you can kind of see some variations there in terms of the communities that are being served. So one other portion of our report that I want to flag is our participation with Moodys. We were able to get Moodys analytic data, which looks at economic and social variables, as well as Moodys RMS data, which explores climate risk. This is part of some initiatives at Moodys, really supporting people who are working on the racial wealth gap and trying to kind of use the great data that they have to explore themes relevant to what we're looking at today. And so apologize for throwing three graphs on one slide, but kind of wanted to highlight the common picture here. And so basically, I'd mentioned the median household income is not necessarily a great guide. And you see that in terms of like the urban representation as well, because if you live in a city, that city or that metro probably has a higher household income, even if you're a low income household. And so I think the historic and forecasted bankruptcies being dramatically higher for the counties in our sample helps to kind of tell that story. And so again, this is kind of looking at the past, and you can kind of see the elevated bankruptcies in the aftermath of the 2008 market crash, and then it's projected into the future as well using Moody's forecasting. The only other thing that I would note in terms of the unemployment here is that even though the gap is fairly small, it's about 0.2% historically across the window of time shown here. You can see again that if you're looking at the beginning of the graph where we're seeing 2010, 11, and 12, again, right after the 2008 crash, the gap is wider. And then again, the gap is a little bit wider in 2020 and 2021, corresponding with the pandemic. And so that, to me, that's probably a sign of some cyclical vulnerability of these counties to economic shocks and economic downturns. And so, thinking about, who has the kind of wealth to mitigate, to be able to mitigate those kinds of shocks as they arise, and how can we make sure that communities have capital when they need it. And that, again, is why the Paycheck Protection Program, part of it, was such an important part of our story here. And then on climate, this is a slightly different methodology. And so I'm going to take just like 2 seconds to explain how Moody's does this. Basically, Moody's takes a baseline year and they update it every once in a while. So I think the current one is like, year 2000. Then they project forward several decades. And then they look across like 6 different risk categories. So heat, water, hurricane, wildfire, et cetera, do weighting, and then they get a composite score. So in this scoring on this graph that you see, 0 means that there's basically little current climate risk and it's not projected to increase. 100 means there's a lot of climate risk in this place already, and it's projected to get worse over time based on kind of an understanding of the climate conditions. And so what we found from our research, we gave Moody's our list of zip codes that received lending. They matched it to postcodes and provided data back to us, and we're able to show that the places that received lending in our sample have elevated climate risk relative to the nation as a whole. A number of our postcodes, about 28%, have substantially higher climate risk scores of 90 or above. And I'll just note too that both lines here being skewed leftward indicates that the US as a whole has elevated climate risk relative to a lot of nations. But again, our sample, even compared to that, has pretty substantial climate risk. So I'll again show this table, which disaggregates it across the different categories. And just kind of be clear here, so if you're looking at one state versus another, it's not that we're giving a an overall state score. It's that we're taking the places in that state that received lending and we're comparing it against other states where there was lending received. And you'll note here that the overall category is sometimes much higher than any of the individual parts. This is just basically because if you take 50 as the normative baseline globally, and you look at, you've got two or three categories where you're above that, even moderately, then compounding your climate risk overall is a lot higher. And so, really notable to kind of see max part of the portion showing that where MDIs are located has climate risk, and then also seeing that places that received climate lending, that received MDI lending have elevated climate risk. So I also want to do a couple closing thoughts to just kind of pull these research threads together. The first thing I want to say is, we've seen a lot of capital get driven to MDIs in the last couple of years, specifically from, Mac had mentioned the Treasury ESIP program, also the equity investments from major banks as part of their George Floyd commitments. And yet MDIs still only account for about 2% of all of the banks in the US sector, and only about 1.8% of the total banking assets. And so if you think about the amount of impact that they could have if we, doubled or even tripled the number of institutions or the number of assets that the institutions control, I think that's, got to be a goal that we work toward based on understanding the impact that they're having in their communities. The second thing is, MDIs need to be on the front lines of climate-based finance, helping to kind of mitigate the risks that we point to in this research, whether it's on the individual, level where you're kind of doing home-based energy, refitting for better energy use or putting a solar panel on a rooftop, or also kind of these broader, industry-wide, clean energy transitions or things like that. All of that needs to have climate finance pieces driven by mission-driven institutions. And then the third thing that I'll highlight, we've got additional research coming out soon that looks at MDI PPP lending as a sector, but even in this small sample, 20,000 loans, I think is really significant and just kind of speaks to the fact that MDIs need to be centered in our fiscal responses to economic crises. I've heard MDIs and CDFIs and other institutions described as first responders, and I really think there's an opportunity for federal policymakers to lead with that mindset and to make sure that they're designing future fiscal solutions based on the assets that are right there in communities. So I think the next couple of years are going to be an inflection point. We've got a lot of federal dollars flowing down to local communities, supporting infrastructure, clean energy, semiconductor production, et cetera. And I'm very confident that MDIs are going to continue to expand the social impact that we see, and look forward to producing additional research that will help us understand that work. So with that, I'm going to pause and turn it over to Amin. He's going to kind of comment on some of this research in light of the broader literature.
Thank you very much, Anthony, and thank you very much, Mac. I think this is really an outstanding report. I think this is a really important major policy and research agenda in the United States, and I think there needs to be a lot more research on the topic that I will say would unlock a growth potential that the U.S. Needs to unlock. I think that affordable credit and generous returns on deposits are key to welfare. And I think that just documenting the important contribution of MDIs is a major asset in the policy conversation in Washington, D.C. And so I speak often to regulators in D.C. and, just bringing the evidence, the hard evidence to regulators in the form of policy papers and research papers is really important. The authors have collected unique data, hand collected. I think it's really at the frontier of research on MDIs. I think it's like pushing the frontier, relative to the work. And I see that Kristen is pushing the frontier, the Chicago Fed. I think this is really a team that is worth watching for the next few years. Some facts that I think are really worth remembering. The MDIs are the only bank branch that existed in 174 zip codes. And another fact is that, my research is at the intersection of climate change and social justice. The fact that the aggregated climate risk score is 10 points higher in areas that received MDI lending. I think here we have a key trade-off that's not obvious between the access to affordable housing and the incentives to adapt to the rising risks of climate. I don't really have an answer to this trade-off. So what do we do to protect the wonderful neighborhoods of New Orleans? It's tough. It's a really tough question, but I think it's worth researching. And so young and maybe not so young researchers who are watching this webinar today, I encourage them to undertake research on this topic. There's very large, deep movements in the volume of assets of MDIs, and there has been an increasing Black-white homeownership gap. I think it's worth stressing that the United States is not making progress in that dimension. At the same time, I encourage researchers to use this report to explore causal relationships. So what causes a narrowing of the gap, and undertake RCTs, randomized control trials. So I want to just make three simple points. One is that relationship banking is important in the 21st century. The internet has not made face-to-face banking irrelevant. In fact, relationship banking is very important. There's, for instance, three important papers I can cite. There's a paper by Pedersen and Raghu Rajan of the University of Chicago. Does distance still matter? There's a paper by Agarwal and Hauswald, Distance and Private Information in Lending. There's a paper by Bellucci, Borisov, and Zazaro in the Journal of Banking and Finance. Papers that document the importance of the distance, the physical distance between the branch network and the borrowers. There's a greater impact of policies such as PPP loans through the physical branch network. There's a better monitoring of ex post performance. And one thing that regulators need to hear also is that internet banking excludes families that do not have broadband internet access. And the report also documents this, as well as other evidence. It's something just straightforward from the American Community Survey as well. So the consolidation of MDIs, it's a part of a trend towards more efficient banking, even though MAC documents the fact that there's been an increase as well in the number of bank branches. Fixed costs have become more important compared to marginal cost of banking. Consolidation ensures efficiency, lower cost of intermediation between deposit taking and lending, which should benefit borrowers and depositors. Non-bank lenders have become dominant players in the lending space. So I think this is maybe something that we need to think about, is what's the role of banks versus non-bank lenders, given that the market share of non-bank lenders has become so large? Is the screening technology that they use, those machine learning techniques that they use, are they neutral? I think that regulation is behind the trends in this space. I think that there's a question of how do we give more rooms for banks to take a greater role in giving loans. Is there any consequence? And I'll argue that yes, there is a consequence, that deposit taking and mortgage lending are disconnected. So maybe that's going to be sort of a strong statement, but do we need a new Operation Breadbasket? Do we see that deposits are flowing towards lending in the same communities? And I think MDIs have a really important role to play in those flows. MDIs can play a key role in improving competition in banking, deposit taking, and lending. And I think that Community Reinvestment Act statistical analysis uses geographic areas that are too large. I think we have the tools in the 21st century to really narrow down on the supply of lending in each census tract. We've had this data for a long time. We've got more granular data than ever, and so we need to pay attention to competition measures such as the HHI, the Herfindahl Index at the neighborhood level in deposit taking and in mortgage lending. So the one thing that I think is really important as a frontier of research is understanding the deposit spread. So we've seen that during this monetary tightening period, the rates on mortgages have gone up, but the rates of returns on deposits have not gone up. And so this has a large welfare impact on borrowers who want to purchase a home but do not get higher returns on their savings. And I think this is something that the report could push on. I think this is a really important question. Final climate comment. I think that MDIs have access to diversification tools to hedge themselves against the large climate shocks. The possibility of a new Hurricane Katrina. How do we deal with this? There is reinsurance, there's insurance, there's securitization, and I think it's really important that MDIs develop these connections with the broader financial network to make sure that they're diversified and hedged. With this, I will again say that this is a fantastic report. I encourage everybody to read it, and I look forward to the panelists' conversation.
Excellent. Thank you so much. I mean, I have to say, it makes my job so much easier when you tee up some of the themes that we're going to put on the table for the panelists. So, we're definitely going to talk about homeownership gap. We're going to hit the digital banking and the non-bank players, talk a little bit about climate and things like that. So really excited about some of those reflections and appreciate your attentiveness to our research. So we are going to turn it over to the panel. In the interest of time, I'm just going to briefly summarize everyone that's with us and their organization, and then when they begin their comments, they can provide further introductory remarks. But we're joined today by Kristen Broady from the Chicago Fed, where she's doing a lot of work on economic mobility. We're joined by Michael Neal from Urban Institute, doing work on homeownership, digitalization at financial institutions. Joined by Tonantzin Carmona, who's doing great work at Brookings Metro, focused on Latino wealth building, but also things like cryptocurrency and the intersection of digitalization and financial inclusion. And then joined by Ray Garcia, who is an executive at Texas National Bank, which is both an MDI and a CDFI, doing really amazing work in Texas. So Kristen, let me start with you, because I know you've done some research on where mainstream banks locate or don't locate versus cash checking centers and payday lenders and things like that. Amin had talked about the index of competition as well. So can you talk a little bit about that research and its implications for access to capital for Black borrowers and the racial wealth gap?
Sure. So I guess it's good to all be together again, because the research that you're talking about was co-authored with Mac and Amin. So you guys feel free to jump in if I don't say the correct thing. But the paper basically found that there were a lower concentration of brick and mortar bank branches in Black and Hispanic neighborhoods. So I did my dissertation on mortgage foreclosure a very long time ago. And I looked at Mississippi specifically, and that got me interested in payday lenders and where they locate versus where banks are, right? And so one of the things that research found is that payday lenders are more likely to locate in low-income minority neighborhoods. And I wanted to figure out how that affected mortgage foreclosure, but it didn't, right? Because these were neighborhoods where people were less likely to own homes, more likely to rent. So having these payday lenders meant that we weren't going to be getting more homeowners, right? Because these places charge extremely high interest rates, up to like 391% compared to say 17.8% for the average credit card, right? And so we know that people who are unbanked or underbanked are more likely to be using these sort of places than banks, and that's not helpful in terms of building wealth.
Yeah, thank you. I think part of the argument that we're making with MDIs is that it is profitable to locate here. You can do it. Point of fact, here are the institutions that are doing it. And so if you're not choosing to locate in a neighborhood, what are the reasons for that? And the burden should be on those mainstream institutions to justify that choice. And of course, obviously wanting to provide alternatives to payday lending. So, thanks for some of those comments. Turning to you, Michael, we talked a little bit about homeownership now, and I've noted that it's a worse racial homeowning gap now than even in the 60s. And so I was curious if you could talk about some of your research on that, what's contributing to the gap, and then maybe some thoughts about what MDIs or other mission-driven financial institutions should be doing to mitigate that gap.
Yeah, no, let me just say, first, I thought the research was terrific. Anthony, Mac, really foundational in terms of not just explaining what's going on more generally, but also taking some of the data on specific banks, Anthony, that you showed to really kind of point out, what's going on. So again, terrific research. Thanks for inviting me. Let me get to this. Look, a couple of things. Number one, let me just go back a little bit to our work. We did some work a couple of years ago, really kind of thinking about, really motivated by, this idea of looking at the supply side. So we've done a lot of work. I've personally done a lot of work, thinking about households of color, what drives their lower likelihood of being homeowners, as Amin has already pointed out. But kind of there's also this question about kind of on the supply side, the capital flowing. What about institutions of color, and what are they doing? So kind of motivated by thinking about that other side of the ledger. Some interesting points kind of really jumped out. I mean, number one, obviously, and I think Anthony, you pointed this out in your work, or Mac, you pointed this out in your work. Obviously MDIs tend to be smaller. There are fewer there are fewer of them, and so they don't necessarily show up significantly in our mortgage lending data. Really being dominated, I think, has already been said by non-banks, by the Quicken Loans of the world, by the Loan Depots of the world. But that being said, what we also see is that if MDIs do lend, particularly thinking about mortgage lending, they will more than likely lend to another person of color, perhaps in part based on the networks, in part because of the communities that they live and they work in. So, here we really start to think about, Amin talked about kind of relationship banking. We start to think about what are the steps that are being taken around credit access that really kind of allow MDIs to, frankly, be more successful than the typical lender, at least in terms of lending to people and to communities of color. So that's point number one. The second point is that we see a degree of counter-cyclicality. Anthony, you talked a lot about kind of cyclicality and the importance of that when we think about banking activity. What we saw was coming out of the Great Recession at a time in which banks were largely fleeing mortgage lending, in part because of capital rules, in part because of other rules that were being put in place. We actually saw Black banks increase their mortgage lending to Black borrowers. Again, suggesting that kind of counter-cyclicality of, at a time in which, in particular, we know that industry-wide mortgage lending standards were tighter. Somehow these particular institutions were able to find a way forward in terms of expanding access. And just to kind of really kind of harp on that, I mean, certainly we saw, that there was we saw evidence of a decline in the share of purchase loans in low and moderate income tracts, but yet and still for Black MDIs, but yet and still their share was greater relative to the banking sector overall. So again, not just the fact that we're lending to people of color, but that capital is also flowing disproportionately to communities that are lower or moderate income. So all of that, I think, points to the important role that MDIs, and in our case, Black MDIs, played in terms of benefiting communities of color. But again, we come back to the size issue, and that's where that's one of the kind of the reasons around technology. Certainly, there are questions about efficiency. Clearly, the research has been going back and forth on this topic. But at the same time, we're also seeing digitalization being the norm across the financial sector. And so some of the work that we did more recently kind of looked at, here we looked at Black credit unions, but we're looking at the share of credit unions that actually have online banking, mobile applications, those types of things. And what we find, again, is that Black credit unions are significantly less likely to have those front-end technological features put in place. And that not only matters in terms of the ability to really scale up their benefits that we've already talked about, but it also matters from a financial inclusion perspective. That is, we typically talk about financial inclusion in terms of unbanked, underbanked. Certainly, that's going to matter on the demand side in terms of who is even included in the financial system itself. But at the same time, the degree to which MDIs are not able to compete because they do not have the technological apparatus in place, then we start to think about financial inclusion on the supply of capital side as well. Obviously, that's going to flow over to the demand side as well, as Anthony and Mac's work has suggested, but it also expands our understanding of financial inclusion to not just thinking about what does it mean for people to have bank accounts and to get access to credit, but also what are the types of institutions that actually are able to extend those financial services. So with that, Anthony, if I just end with one last thing, it's this. It's that, we have seen that the Black-white home ownership rate gap is wider today than it was when the Fair Housing Act was passed back in the late 1960s. We also know, though, that because of relationship banking, because of knowledge of the community, that MDIs play an important role in terms of being able to address that. And so there are certainly issues around competition. I mean, you talked about CRA. We've seen some research evidence of competition that CRA brings with MDIs. But I think what we need to really think about is when you're trying to get down to the lowest part of that income distribution, it's really the MDIs, it's the CDFIs, it's those mission-oriented institutions that have consistently demonstrated an ability to expand access to those communities.
Oh, thank you, Michael. It's a lot of insights to kind of think about and really helps to, bridge some of those, causal questions too, of like, what is preventing the closing of the gap, even though we have these institutions. So thank you for that. I want to turn now to Tonantzin. You've done some recent work kicking off a new series at Brookings on Latino wealth that disaggregates net worth along looking at different kinds of assets and liabilities, and that also disaggregates the category of Hispanic into thinking about countries of origin and how that may impact outcomes as well. And so I was hoping you could tell us a little bit more about the goals of that research and then share some of the findings that are relevant to some of these themes.
Absolutely, happy to. And thank you, Anthony and Mac, for your research. It was just fascinating to read it, but then also hear about it again today. I really appreciate it. So right now I just launched, I'm a Rubenstein Fellow at Brookings Metro, and I just launched a series on Latino wealth. Just the first piece of the series came out a few weeks ago. And the idea really, or at least the goals were, Latinos in general are a very understudied population, and Latino wealth is an incredibly understudied population. And so I kind of wanted to start with providing some basic building blocks to understanding just the issue at hand, and slowly work our way into providing some of the context behind existing wealth disparities. And so the first piece really does do that disaggregation. And the idea was that, we talk about wealth, we understand wealth is incredibly important for communities, especially communities of color, for purposes of, economic and upward mobility, but also economic security and the ability to weather financial storms. But wealth, when you just talk about it, it sounds so amorphous, and it's really hard to untangle, like, what exactly are we talking about when we talk about wealth? And so really, digging down and saying, like, when we talk about wealth, these are the different asset types, these are the different debt types. And, with Latino communities also, I thought it was important to very much center the diversity of Latino communities, because it's often talked about as monolith, but we have such racial diversity within Latino communities, immigration status, different national origins, differences depending on generations. And so that's kind of the idea, is like, we need to understand Latinos first before we can start to untangle how we actually address some of their disparities. But it's listening to folks today and thinking through, what are the ties and why does this matter? I think in terms of just like the asset types, you already see that, it's not just debt that drives a lot of the wealth disparities, it's differences in asset types. And so when you think about, access to mortgages, you think about even equity in businesses, or you think about just basic savings and checking accounts. You have to think about different populations and what access they have to building those assets. What are the barriers? And MDIs are essentially, as we were talking about, they're helping to be that conduit to provide access to those assets. But on the debt side, you see that, like, historically, when large banks leave communities or bank branches leave communities, you start to see, as Dr. Broady was talking about, these alternative financial services pop up in those places. And so we really do need to ensure that when we're talking about debt, we're enabling folks to not have just access to bad debt types. I'm talking about it very colloquially because we talk about debt. It's like sometimes debt can be good. Sometimes debt, if we're talking about in terms of like credit, can help you build wealth. And so distinguishing good debt versus bad debt. And we want to ensure that communities have more access to good debt or the types of products that actually enable them to build wealth versus bad debt, which is going to extract their wealth. And MDIs are certainly a space that can provide that. And so, like I said, I'm just in the preliminary phases of this, but the idea is like we want to start to untangle the different asset types, the different debt types, and then really highlight Latino diversity. And I think another important piece of this, which I think is why your work is so fascinating, is that also opportunities and barriers to wealth building really do also vary by region. It's not just federal policies. You have a lot of opportunities or barriers based on the state and local level policies as well. And so being able to examine the differences by region will also be really important.
Excellent. Yeah, a lot there. I highly recommend everyone go read that report. One thing that just kind of had floored me was Tonantzin finding that when you exclude home equity, the racial wealth gap in terms of Hispanics versus whites is actually a little bit larger even than when you kind of include home equity. And so, we talked a little bit with Michael about home ownership, but recognizing it's not just get more people into mortgages, even there are other things like that. And, one of the things was, how much are you investing in the stock market and things like that. And then of course, thinking about intergenerational wealth, do you have, a wealth transfer that you're starting from in terms of having money into the market that's accumulating interest and things like that. So yeah, a lot of things there to kind of ponder and then connect to as you ended with, the specific regions and localities that you're in to kind of get a sense of, what are the specific dynamics driving wealth disparities in my community. And so with that, I want to turn to Ray. You've shared some things with me that I'm excited to kind of hear you share out in terms of the impact that you're having in the communities that you're serving. So can you talk a little bit about Texas National and the community that you're in, the context that you're in, and some of the ways that you're helping to drive financial inclusion and wealth building?
Absolutely. So first of all, thank you for the research. It was excellent. As the MDI, I guess in the group, it really resonated and really hit home as I just find myself really nodding along as I was reading through the entire paper. So thank you for that. I think it's excellent work. Just a little bit about us. So we are at MDI and we're a CDFI. Today we sit at about $750 million in assets. We have about 8 branches in what is considered the Rio Grande Valley area. So this is South Texas. We're talking about climate risk. It is 98 degrees today here. It's really hot. And we're also, just 5 minutes away from the border with Mexico. So as you can imagine, our communities are largely minority communities, a lot of Hispanic, Latino communities, big Latino community, to where, we have a lot of first and second generation immigrants, where either Spanish is their first language or at least a second language. And so that's really what our community consists of. And, not to get too much into the stats, but, if you look at the counties that represent our area, I think one of the things that the research paper talks about is sort of the poverty rates and the economics of what the communities that the MDI serve. And so we have 4 counties in the Rio Grande Valley, and they're all considered, persistent poverty counties based on US Bureau data. And there is a total of about 357 census tracts that represent our community. 311 of those are considered underserved. So that's about 88% underserved, and 99% of those are considered minority communities. So just to give you a little bit of a visual of the groups that we're working with here locally. And then in terms of median income levels, if you look at our metro and non-metro area income levels, they're about half of the national average for both of those. So again, really, so that just tells you that obviously there's a need, and that's really where, as an MDI, we try to come in and we try to, do our part to support. And again, I don't want to paint such a gloomy picture. There's actually great things coming to our community, as we hear a lot about nearshoring and reshoring and just expanded trade activity with the U.S. and Mexico. I think our community is, poised for great things in the future. And that's also, again, where we have a responsibility and a commitment. So, when we talk about financial inclusion, so much, and I think Michael, you touched on this, and Amin as well, so much of it is just building trust, right? Relationship banking, building trust. And I think, in the research paper, actually, there is a section in there, and I want to make sure I don't butcher this, so I wrote it down, because you just said it so well and so eloquently. And you talked about essentially the social capital and the ethnic capital that we build, right? And I think that's one of the great tools that we use to sort of build on that trust. So we leverage our bilingual and bicultural sales force to really build those relationships and ensure that our community is comfortable with the banking system and trusting the banking system. But then we also take a position of where knowledge is power. So we have financial literacy and financial education programs that we do. We do a ton of outreach. This year alone, we've probably impacted over 500 different individuals, whether it's in schools or with different trade groups. So we've done a lot of financial education as part of our financial wellness initiative. But then also just in the products that we're putting out there, we really try to make sure that we're putting out compassionate and responsible products. Things like free checking, things like maintaining no or very low balance requirements on the deposit side. Also, in terms of our infrastructure, making it very accessible, having mobile banking available. And on the lending side, really providing a path to credit, right? I think a lot of what we deal with is, Christine, I know you touched on payday lending. So there's a lot of that in our community as well. And what we try to do is we try to create a path to credit through, small dollar consumer loans, small dollar business loans that, people can graduate into more advanced and more sophisticated products as they go along and build that positive repayment behavior. So, that along with, tailored products such as ITIN mortgage products, or again, just more digitization and really partnerships as well with local CDCs, housing authorities, nonprofits, and really even other banking institutions. So we really try to take a very comprehensive approach to financial inclusion and wealth building overall.
Awesome. Thanks for those comments. I'm going to stay with you for a little bit, Ray. I hope that's okay.
Sure.
You had you go last in the order. I want to make sure that there's a little bit more time with you. And so Michael had talked a little bit about the digital adoption curve and how a number of minority serving institutions are kind of falling behind on that. But here again, I often point people to your bank as kind of an example of some of the cutting edge things of what it looks like to use digitalization in a way that's still mission driven. And so I know you've done some things, some pilots around, getting capital to consumer lenders and consumer, borrowers, and also to small businesses that may have thin credit or no collateral, and you've used technology to do that. So can you talk a little bit about that pilot process and also some of your broader goals for digitalization at your institution?
Yeah, absolutely. I mean, I think digitization is such a big strategic priority for a bank, and really it should be for any bank that's trying to be just vigilant and trying to stay competitive in today's marketplace. But I think one thing that I will say, and I think you touched on this a little bit on the, NBA put out a great article on navigating the digital banking frontier. And I think the first thing that we had to do is sort of accept that the mindset needed to change a little bit. And rather than looking at digitization as sort of an endpoint, really looking at it like a journey, right? And that it's going to be ongoing and evolving just as needs continue to evolve. So I think what we've done is we just tried to be, one I would say is that we've really fostered responsible innovation and ethical banking into everything that we do on the digitization side. But then also is that we try to be very deliberate and very thoughtful about what are we looking to achieve with this particular digital strategy. So, are we trying to expand customer acquisition, for example, or are we trying to lower cost? Are we trying to build, revenue by maybe investing in a no loan solution or lending platform, or gaining efficiencies by putting in a system that allows us to building workflows on both the loan and the deposited side? Are we reducing risk, right? Fraud, cybersecurity. Even if you look at some of the systems that we use nowadays for things like suspicious activity monitoring and compliance management. So there's so many things, but I think what we try to do is be very intentional about what is it that we're trying to do, and really just take it one at a time, because I think the other thing that you as a community bank, is that we were going to have limited resources and capacity. So we try to be very thoughtful and just kind of working one at a time. But knowing that ultimately, I think it's where we need to get to. And you mentioned the two pilots that we have, and so happy to report that one of them is no longer a pilot. We've graduated that into a full-on banking product, so really excited about that. And so we approach it two different ways. I would say one of the products that we did that again is now in our website is a consumer lending solution, and it is completely digitized. You go into our website, you go into the link where you want to look for personal loans. You type in your information, logs you in, and if you have a bank account with us, it will prompt you to choose the bank account that you want to be analyzed. There is automated models that are being built in there to assess ability to repay and ensuring that we're going to put the customer in a good position to repay back this debt. And it's a short-term unsecured loan at rates that are well within our usury rate laws. As opposed to what we're seeing on the payday lending industry. In Texas, I was looking at some stats by the Center for Responsible Lending. I think Texas shows rates of about 660%. So it's, again, extremely predatory. And so I think what we're trying to build is a much more compassionate and responsible solution on that side. And then the other pilot that we still have ongoing as well is something a little different. We're trying to look at alternative data and how we can leverage some of that to provide access to credit on the small business side. Talking a little bit about our community. So we still our community still largely relies in cash, and we live in a cash economy down here. So one of the interesting things about alternative data is when we're looking at transactional data to underwrite some of these small businesses, we can really capture a lot of that, right, through deposit activity. And we can facilitate a small business loan, unsecured small business loan, that is completely digitized through a pre-qualification process. Right now, we're looking essentially at leveraging our own data to send personalized, customized digital marketing campaigns for these type of products. The idea of it, in terms of where it can evolve, is that eventually customers can use other bank accounts as well, obviously with their permission on a volunteer opt-in sort of approach. And we can look at that data as well to provide access to credit within our institution. So a lot of things going on the digital side. I think it's those are just some examples of some of the things that we're doing, but still obviously looking to pursue other things and really just help expand some of our strategic efforts.
Excellent. Thanks so much for sharing that. I just get so excited when I hear some of those, those programs, because it's, it's the perfect sweet spot of like you're adopting the technology, you're doing all that, but you've still got that mission-driven focus that I think our institutions just really bring to the space. So thanks for those comments. Kristen, going to go back to you. I haven't heard in a little bit. So we're talking about technology and things like that, and obviously people are curious about the non-bank players as well. So I know you've done some research on fintechs and how they kind of factor into this conversation about financial inclusion. So talk a little about that research, and then how you see them fitting in with mission-driven financial institutions.
Sure. So we looked at the financial health gap, which is a series of 8 things that look at like how can people repay their loans, or what is their income, not just wealth, right? Because we can get to wealth at a national level, but it's a lot harder at the neighborhood level or the individual level. And so we found that Black people had much lower rates of financial health. That was the first thing. And I guess like when you look at that, what can fintechs do? What are they doing? Ray kind of touched on some of it. So one of the things is the FICO score. So we know that on average, Black people have the lowest FICO scores than Hispanic people, than white people, than Asian, right? So not just looking at the FICO score when making lending decisions, that there are other algorithms that can be used. Some of them may be controversial, some of them may have bias, but just trying to figure out what are some other ways that we can figure out credit worthiness outside of the FICO score is one. Providing access to digital banking, doing things like buy now, pay later that is interest-free or incredibly low interest. A lot of programs like that do provide access. And I guess another thing to think about is for people who may have an account that is overdrawn, right? Having another way to cash their checks. So Some of these fintechs have relationships with Walmart and other companies where they can cash their check that way without having to go through a bank. Of course, I'm not saying that banks are bad. Obviously, I work for the Fed. We regulate banks. But just thinking about alternatives for people who may not have access to a bank for whatever reason, or may have a lower credit score. And then I guess a couple of other things as we think about fintechs, partnering with HBCUs and other types of institutions to increase financial literacy, educating people on investing and types of accounts that are available, helping people learn how to save and spend properly. All of those are things that fintechs are doing and can continue to do.
Excellent. Yeah, I really like that last point about HBCUs too, right? Like talk about a series of institutions that are often overlooked, but punching above their weight and have tons of talent, tons of resources, tons of knowledge, and are anchor institutions in the communities that they serve. So yeah, definitely think, creating those ecosystems of partners is vital. We're talking about digital banking and technology and things like that. And so Tonantzin, I know we can't go through a whole conversation with you on a panel and not ask you about cryptocurrency. We know that cryptocurrency is often presented as a way of increasing financial inclusion, especially for the unbanked or underbanked, and as a way for kind of doing wealth building for people of color. But your research provides a little bit more nuance. And so I'm curious if you can kind of talk about what your perspective on crypto has been and how it fits into this conversation of financial inclusion.
Sure. Yes, fascinating topic that I never intended to ever research, but I was drawn to this topic when I was hearing a lot of reports on communities of color, specifically Black and Latino communities, that were gravitating towards crypto because of the financial inclusion benefits. And it was kind of talked about in two ways. Financial inclusion in terms of serving unbanked or underbanked populations, so people who don't have access to specifically like the bank accounts to be able to make financial transactions. And on the other hand, for wealth building purposes, so people who were thinking about it more in terms of, oh, I'm going to invest in cryptocurrencies, hold on to it and hope that it grows. But in doing my research, I at least started untangling and I really just wanted to understand, like, so how does this work? And, I ended up finding that actually cryptocurrencies come with a lot of risks and drawbacks. And this is, during the hype, so a lot of people disagreed with me. And then the markets crashed. And I think people started to recognize like, oh, okay, maybe we should actually think deeply about, how we're promoting these things to communities of color. And I think the larger lessons were that, with technology and innovation, like obviously there's a lot of pressure to, stay ahead, ensure that we're innovating and we're keeping up with technology. And it's unfortunately always talked about in terms of the upside. I think upside is good, innovation is great, but when it comes to consumers and folks of color, and honestly, any like vulnerable or marginalized community, historically excluded community, you also want to take into account potential risks and drawbacks, and so I think one of the things that I talk a lot about is the idea of just access. Like access is incredibly important for communities of color, but you want to ensure that access, whatever that product or service is, doesn't come with conditions that undermine the benefits. And so that's why, as we think about, tech, innovation, fintech, all really exciting things, there's really, there are spaces in technology that are incredibly promising. But regardless of what it is, it's always worth studying to ensure that, communities aren't put into harm's way whenever they're accessing certain technologies. And I do think where like MDIs kind of come into play here too, is like, as they're innovating and also providing access to products, they're providing access to products and services that are safer. They're providing access to things that, people actually need. And I do think that that was something that, was a bigger lesson for crypto, is when you started to look at anecdotes as to why people were gravitating towards them, they felt that they were historically excluded. Like they were like, I do not have access to wealth building avenues. I do not have access to, you name the product or service. And so of course they're going to seek out alternatives. And that to me is a very understandable decision. When your choices are constrained, you're going to seek out whatever other alternative you can to build wealth. And so, rather than promote things that are unsafe, we need to make sure that we're promoting the types of things we know actually work. And I think that's where, like, with MDIs, they, might have more trust in certain communities. They have access to certain product, or they can provide access to certain products that are safer. That could be like a nice little space too, as we start to see this, like, Ray was talking about, it's not just a point, like it's actually a journey. You're going to see new iterations of new technologies come into play. And so how do you develop like a system or framework for folks to say, well, actually, we did our due diligence on this. This isn't safe. However, this other product or service might be better. That could be one avenue where MDIs play a bigger role.
Awesome. Yeah, thank you. I think, yeah, the term that I've seen you use, predatory inclusion versus, actual financial inclusion. So I think, being able to parse those things together, and then, one of the things that came out of Ray's pilot, being able to say, like, do we have the right threshold? Are we making sure that when we're issuing a loan, it's based on an ability to repay? We're not actually going to saddle a borrower with debt that's going to hurt them. So, really resonate with a lot of those comments. I do want to say, again, a reminder that you can put questions in the Q&A function, and so we'll reserve a couple minutes toward the end for those. But I want to go back to Kristen briefly, because something that you said, Tonantzin, was about technology kind of having upside and also potential downside, and wanting to pay attention to both things. Kristen, I know a lot of your work is focused on automation and AI, and its potential to kind of disrupt workforces and lead to job displacement or things like that. And so I'm curious if you've got some thoughts about MDIs, both as employers in their own right, but also as sources of capital that can impact local labor markets and maybe mitigate some of that concern.
So I would first say that Anthony is being incredibly humble, because it's our research on automation. Anthony is a co-author of the latest paper. So I guess when we think about automation and who it is likely to impact, we know that it's likely to impact Black and Latino workers more than white and Asian workers. But I guess one of the things to think about is funding projects for small businesses, right? That can help them to use automation. I don't want to go too far into this. I'm working on a grant with some people for a type of automation. So when you think about a picker of different kinds, something that reaches out and grabs, right? And so the reaching part, the arm, is fairly accessible. It's that end piece that picks up the box or move something from one place to another. That is expensive, right? So it's breaking down what automation is. What do these machines do? How much do they cost? What do companies need in order to be able to have automation? And are there ways that MDIs and CDFIs can fund that? Just thinking about, what do you need to be able to automate? And then on the other hand, though, it's like, if you do automate these processes, who is it going to impact, and planning for that, right? So our research looks at the particular people and jobs that are going to be impacted in the next 5 to 10 years. So how do we prepare those people for jobs that are going to exist and are going to be less impacted by automation? So funding research, funding workforce training programs, helping to build pipelines between universities and agencies that are going to be doing hiring. All of those things are things that MDIs can do in partnership with others.
Awesome. Yeah, thank you. Looks like we've got a question in the chat about going back earlier, Mac, to your point about certain portions of the literature saying that MDIs are actually less efficient, and then when you control for certain things, it seems like they're more efficient. And this person is wondering, what other criteria do you think we should evaluate success by, and what are the other ways of seeing kind of unique strengths compared to other institutions? I think we've covered some of that, but Mac, if you want to talk a little bit about that, and then others on the panel, Ray, if you want to talk about what you think impact should look like, would be curious to hear.
Yeah, so I think, that's a great point, that there should be a variety of criteria to evaluate success. And I think, it's part of what we've been talking about today, about where banks choose to locate bank branches, where they lend, and who they lend to. And going back to Amin's point about the CRA is, the CRA is intended to do that, to drive lending to low and moderate income communities, but it's extremely limited in how it evaluates banks across those measures. And so I think it's really missing the great work that's being done by so many MDIs and the work that they're doing in these communities, because as our research highlighted, there is a significant difference in the types of communities served. And so I think there needs to be a higher, a greater focus on that in, whether it be CRA or some other kind of regulatory measure, that banks need to receive some type of credit for the lending activity and physical presence that they have in these communities. But I'll also open that question up to any of the other panelists and to Amin as well, if you have any thoughts on that.
Well, I'll just say that, I think more and more, obviously, CRA, HMDA, and, CRA, and then the new 1071 rules, some of these are aimed exactly at doing that, right? Is at measuring impact and measuring what success looks like and how are we delivering results. And, a lot of these are focused on essentially who you're lending to, what type of places are you lending to, what type of projects are you lending to, and really capturing that data on a very granular level. That is very difficult for financial institutions. It's not an easy task. This is why I think 1071 has gotten a lot of controversy, but it's important that we do that. And frankly, we're already working and taking steps on the data management side to come up with a robust data management strategy to capture some of this data. I think, first of all, I think it's important from an impact standpoint to show what we're doing, but then also to really kind of showcase what other opportunities are available if we have access to this data. So I think it just makes sense to really look at that in a very granular level. So things like demographic information, what communities are you lending to? Are you a first-time home buyer, or are you a small business owner? And really get into the weeds of that impact data measurement.
Fantastic. Ray, another quick question that popped in from the chat for you. Can you talk a little bit about your I-10 product offerings and how big that is as part of your kind of business model?
Yeah, absolutely. So I would say it's been recently launched. It's funny because we started this as an exercise. So we started attending a lot of the conferences that we do as CDFIs, right? So what we started hearing from some of the bankers, and so one of the story that kind of impacted us is here was a bank in Minnesota that was doing great work in helping the Hispanic community. And when I thought of Minnesota, I just, Hispanic is not what I think of, right? And so here we are 5 minutes away from the border. And I said, you know what? We have a responsibility to come up with a solution like this, right? We have a lot of folks that are in the process of acquiring their citizenship or the residency or whatever the case might be. And I guess what we realize is that it's a product that a lot of institutions are looking at. And what's interesting is that there's been a lot of great success stories. Some of those portfolios are some of the best performing portfolios, because really when you get into kind of if you look at the demographics of usually who is an I-10 borrower, these are folks that are trying to succeed in this country. These are folks that are trying to build an excellent track record, especially when it comes to credit. So, although there's maybe this initial perceived notion that it can be perceived as higher risk, some of the data that's out there actually suggests the opposite. So we actually started by looking at some purchase loans on the I-10 side. Again, we had talked a lot about responsible innovation and how we kind of employ an agile approach, just kind of learn from this before we take a more active approach. So we've had recent purchases, roughly about $20 million worth of mortgage I-10 lendings, and we had great success with it. We've had no delinquency so far. And what's funny is when we made the purchase, the typical transition, right? You're trying to change them into your system, work that process, work the direct debiting for their payments and all that. And what's funny is those were the first customers that were calling us actively, like, I want to make sure that this is a success. I want to make sure that I'm not skipping a payment here. What do I need to do? So, we feel really good about it. I think it's our responsibility as well, just given where we're at located, and we're really excited about it. So we have officially created a product internally, and we're ready to grow it.
Fantastic. Michael, I want to give you one last question because I know it's been a little bit, and I wanted to think about going beyond just the statistical data. This was something that, I think maybe was a downsize of our report. There's only so much room, there's only so many pages, and we had a lot of kind of numerical data and a lot less kind of qualitative. And so I know very recently you put out some research on financial trust where you've pulled in voices of people talking about their experience. And so can you just talk a little bit about that thread of research, and then maybe give a couple comments on how qualitative data can fill in some of the things that we're doing here?
Yeah, no, that's I gotta be honest, I'm sitting here getting so excited listening to everyone. And I know that's mostly me, but this is all simply amazing, and I just happen to love this topic. But let me say that to your point, Anthony, I think we have talked a lot about, the quantitative evidence, and that's important. It's important to demonstrate these challenges and also these successes. But there's a part of this, I think, that we have started that is playing out in the background, and that is the history of structural racism that has systematically excluded people of color from the financial system, limited access to wealth, whether that's through racial covenants, whether that's through redlining, as well as even destroying the wealth that communities of color have tried to create. And so there, examples like Tulsa Massacre come to mind. And so, I think that there's certainly, there's a large part of this that is rooted in the fact that communities of color have frankly systematically been harmed by the financial system and by actors in the financial system. And so there is this part of, asking them to come in and participate in something that has typically hurt them. But, and so I think two things there. Number one, MDIs play a critical role, but in terms of being able to build that trust, in part because, when you walk into a bank branch, you will often see a person of color on the other side. But in addition, because of the relationship banking kind of approach, but also because they play a critical role, frankly, in understanding the nuance. I mean, we talk about ITIN lending, a nuance for a particular community that, Ray is talking about. We are learning how to do this well, and hopefully that then becomes a template that other institutions can then copy. So Anthony, to your point, I think there's a part of the quantitative evidence is important. It plays a critical role in helping us to size the problem, to understand causal linkages, as Amin has pointed out. But that qualitative evidence really helps us to understand, what are the reasons why? What helps to really, what are people actually thinking as a way of filling in those gaps, but also as a way of motivating where the research can go into the future. I mean, so I do think that this area of trust, which is so critical to the functioning of the banking system itself, is an area that qualitative research suggests can stand additional exploration.
Well, thank you so much. I'm cognizant that we're getting close to the end of time, so I wanted to provide some closing remarks before we send you on your way. As I was preparing for this event, I was thinking about the fact that the United States is a bit of an outlier in terms of the sheer number of banks that we have, several thousand banks versus other nations that have only a few hundred or even less. And the majority of the banks in the United States are community banks, right? They're 10 billion or less in assets. They're rooted in a community, and many of which, including the MDIs and CDFIs, are mission driven. And I think a movie like It's a Wonderful Life captures in the American psyche this idea that we want our banking sector to be based on relationship banking, and we want the banking industry to do good with capital beyond simply turning a profit. And I think you've heard examples of what that looks like today. So today we brought together researchers from the Academy, from the Federal Reserve System, from think tanks, and of course had a really fantastic rep from an MDI itself. And they've all shared insight on the wealth gap, disparities in financial access, and ideas for deepening financial inclusion. And so I hope that you'll take these conversations and these ideas and themes back to the organizations that you're part of, and think about, where your organization can fit into this work of financial inclusion and wealth building, and ways that you might be able to partner with MDIs or other mission-driven financial institutions. And then, as Max said, we will be posting the webinar on YouTube. We'll be sharing the recording, as well as some other resources, links to the report, et cetera, to all of you who registered. So we'd love for you to share those resources on your social media, or send them to people that you think it would be relevant for. We'd love for you to cite our research and work that you're doing where it's relevant, really trying to be that resource for you. And then, of course, please do follow the 21st Century Cities Initiative at Hopkins. They're doing really awesome research. Pay attention to the work that National Bankers Association is doing as well. And be sure to sign up for future events like this. But just want to thank all of you panelists and participants for what I thought was an amazing event. And thank you all attendees for giving us your time. Have a great rest of your week.
Thank you.
Bye, everyone. Thank you.